Hi, everyone. I think half of the people in the audience are friends who are sticking around for moral support, and the other half, I don't know what you're doing here. So let's... I'm just going to make this as simple as possible. Whoever's on the panel, please join us, okay? And we'll start this as it... Because I can't see. Okay, fantastic. So, how does it feel to be in the graveyard shift? I think this is the last session, right?
Yeah, so we had a bet going. I said 12 people would stick around. I'm really, I lost, but still I'm happy that it's a lot more than that.
We had a good turnout. We had a good turnout. Actually, I'm quite impressed with this turnout. This is the best graveyard shift I've ever seen. Okay.
Woo! Woo! And the selfie.
Sorry?
And the selfie now.
And the selfie, yeah. Once we're done, we'll do the selfie. Then we can see the real number of people. Okay, so let's do intros. Christian?
So I'm currently an advisor with Hotjar. I think that's what it says on the program schedule. Hotjar is a B2B SaaS startup based out of Malta. 40 people working remote and has extremely well executed. And before that, I was a VC for about 7 years. And I still do some investments. I still refer deals to VC funds. And I have a couple other advisory roles, very often for equity with smaller startups that can't pay me.
Steph?
So I'm Stéphanie Hospital. I used to be in the corporate life where I had the chance to work with Stéphane in the same big company. And the two of us, one day we decided not talking, but we realized that we decided to follow the same path, moving to the entrepreneurial world and becoming a VC. By the way, at the moment I decided to become a VC, I had no clue what it was to be a VC, because I've been many years at Orange managing teams, building a new activity, always in the digital and innovation, making partnership with big internet players, making some acquisition. And I had a chance during 3 years to be at the board of Dailymotion, a leading video platform, sharing every month 3 hours with 4 or 5 of the most relevant VC in Europe, Benoît Grossman from ID Invest, Philippe Colombel from Partech, Fred Destin from Axel, and a couple of others. And then I realized, wow, what they're doing, it's cool. They're spending their time helping entrepreneurs, working with cool companies. So I want to become a VC. So this is why I decided to leave Orange to create my own fund. And then the reality check came to me because I discovered what it was and how complex it was to raise money, how complex it was to definitively move into that field. And I decided, okay, I'm not here to do the traditional way. Let's try to fight with my advantage. I'm operational, international. I love building teams. So let's disrupt the venture industry and do something that is much more accurate than what the traditional VC are proposing to entrepreneurs. And this is what we are doing with OneRagtime, and I will explain you later on the model.
Okay. Well, that's a good shoe-in. What is your model? We're talking about alternative ways of investing or alternative methods or just creative ways of doing stuff that don't involve VCs like Stéphane's VC. Okay, so if you don't want to talk to Stéphane, what are the alternatives on the table? Okay, and if you do want to talk to Stéphane, okay, let me know. I have a commission on the side. But anyway, so let's start off with Steph again. What's different about your approach?
Well, first of all, what I discovered in the world of VC is that it was a world of constraint. You need to raise your fund, and raising the fund, you need to have closing date with people committing to come with you on the same date. By the way, in Europe, if you're a newcomer, except 1 or 2 funds like Point9, if you don't have the backing of institutional people, then you will not be able to attract other investors because they rely on the institutional people to back you. And the issue with the institutional people, that it be the BPI or the European Investment Fund, is that when they invest with you, they impose you constraints. You need to do 60% at least of your investment in your country, you need to respect some rules, etc., etc. And then they impose you, like the other investors, to have some dedicated period of investment and then period of disinvestment. which at the end of the day is not at all aligned with the life of an entrepreneur. So we decided with OneRagtime to create a different model, relying on the tech platform. So we build a crowd equity platform. We have an application, we have a web platform, we have behind a lot of data, and we're trying to digitalize as much as we can the journey for investors, helping them to find the right opportunity, because this is also an issue with the fund, is that fund, as an investor, you invest without knowing on what you are investing. So you don't know. You give your money to someone, the person, and by the way, you don't give the money. You commit to give the money. And I can tell you there's many funds which have commitment from private, often it's with private investors, then when they have to call the money to invest into a company, they're not able to have access to that money. So what we're proposing is a very transparent model where the investors can select where they invest. We do all the due diligence. We select the company for them. We create an SPV dedicated vehicle which has no liquidity event. And we welcome the investor to invest through us into the company in early stage. And that's one area. We're building all the tech and the data behind to be able then to do much more than just investing in early stage, but also helping our corporate partners or LPs, also called investors, to access to late stage opportunities. As we're doing some advisory work, helping them to invest in late stage, helping large corporations to acquire company. Then we develop the model. So it's an advisory also. And last but not least, as we have development team, growth hacker, marketer, we're building a true acceleration team, first working for us, developing the fintech OneRagtime, but also able to help our portfolio company in development, growth hacking, design, business development, and human resources, as we're also gathering a lot of data on the company, including within the company. So in few years, we will have a very relevant base for human resources, I guess, also.
I'm just a bit confused. How big is your team? Because it sounds like you do a lot.
Well, as we are relying on the platform, we have the chance to have a very efficient way of working. And whatever we do, we try to automatize so that it be painless, and not painful for us, painless for the investors, painless for the startups. My co-founders is an investment banker, so on the advisory side, I've got the chance to rely on a team of 50 investment bankers. So whenever it's a big deal, they're helping us. But the team today is 15 people across Paris, London, and Barcelona. And then we're gathering a network of mentors, a network of investors. And as they can choose where they invest, then they can be actively involved in the portfolio company. So we are leveraging the power of a crowd, of a platform, to be able to develop this ecosystem with entrepreneurs, investors, and mentors. And we think that going forward, we will be a kind of animators of that community.
Okay, good to know.
Animators.
Animators, yeah.
Animators, orchestrators.
It's very ominous. Hopefully it doesn't come down to that.
No, I'm dreaming.
So Christian, you, from what I understood in our very brief conversation about what you do, you look at investing from a non-equity perspective. How can we come in and participate without doing equity buying?
So that's really the end of the thought process. But maybe I should I have to start from the beginning. So I spent total 7 years in two different VC funds, and I've seen a lot of companies, good companies, that at some point either plateaued in their revenue expectations or in the realization of what they could achieve, or that simply even went bust. Insanely funded companies usually go bust. Not usually, very often I've seen that. What I call these companies startup roadkill. It's unfortunate in the VC business model that out of the 20 companies a VC fund invested into, one company becomes very large if they're lucky, and the other 10 maybe die completely, or 15 somehow return the money. But there's usually not much of an outcome for the entrepreneur, and that is something that has bothered me greatly. I personally administered some of these exits, where the fund had invested something like 400,000, and the company was sold for 200,000, which means there was no money for the entrepreneur at the end of the journey, and the VC made half their money back, and maybe there was something split with the angels or whatever. And that is something that bothered me greatly, and I noticed that a lot of these companies actually were, at a time when they took on the VC money, were actually pretty healthy companies, and especially in the sector that I focus on, B2B SaaS. A lot of these companies can be very healthy companies, growing very relatively slowly, 5, 6, 7% a month, on a very humble and nimble team. So that's something that then I basically studied for the last 2 years. I talked to a lot of bootstrap entrepreneurs or entrepreneurs that had just taken on very little money, typically from small seed funds. And then I also ran into Hotjar that I actually wanted to invest into as a VC, and they decided not to take my money because things were going so well. And they said if we would add more or VC money at all, it wouldn't solve any of our fundamental problems, which is, recruiting, and we have the money in the bank to do recruiting. It's just we can't find the right people. And the second is some more of the operational challenges. So, so basically, what Hotjar then did is not take on any money, and not because they didn't take any money, but what happened is it went very well, and they have over 10,000 paying customers. Hundreds of thousands of users, free users. They have millions in revenue. They just published a blog post about how they went from 0 to 1 million in annualized recurring revenue in 6 months. And so the longer I studied that, I had to revise some of my own personal assumptions that I had trained in the VC world, as a VC apprentice, I guess. And that was that you need VC money in order to be able to grow. It's just not true. And that most of the companies that apply for VC money or that talk to VCs actually don't need it in the first place, or they may need it later. So I've talked to a couple investors around that, and obviously, a lot of people are defending the VC investment equity model because it's a high upside model, and no one really cares about the downside. The problem is the entrepreneurs care about the downside because it's their company, right? And you're forced to spend more money than you may actually want to, or it's the technicalities of the investment model that the VC gets their money back first. So there's a lot of restrictions around that, and what I've come up with, or actually not come up with, that's not true, but there's a couple of funds that are experimenting with this in the US. It's very early stage. It's called revenue-based finance, and especially, or probably only, I'm not sure, but in B2B SaaS, it's something that can work very well, where you say, I'm giving you a loan, but that loan is not to be paid back on your profitability, but it's to be paid back on your revenue. And whether you're slightly in cash flow negative or just about break even, or whether you're actually highly profitable, I don't really care. The point is, if you're in a high margin product, which is B2B SaaS, then you could pay that loan back and you could invest some money into marketing or hire one more person. But basically the point is you can do this at a very low scale. Typically, companies don't qualify for debt at that early stage where this kind of financing would apply. So that's something that I learned, and where I had to personally also revise many of my own assumptions. And I encourage entrepreneurs at that very early stage, they're just launching an MVP or come out of beta or something like that, not to take on VC money too early, unless, if you're building the next robot, Boston Logic, then that's fine, or great marketplaces or whatever. But in B2B SaaS, I think you can hold out until you have 10, 15, 20,000 MRR, and if you then consider your financing options not having your back to the wall, but being profitable or at least break even, then I think you're in a much better position.
Go ahead.
Yeah, so this is the first advice I give to entrepreneurs when I meet them. Think about the revenue fundraise. It seems so obvious, but the first things you have to do when you are an entrepreneur, you want to be entrepreneurs because you want often to be free. So to be free, you need to be working for your own life, and for that, you need to be thinking about how I can be free in my new business. And the best way to be free is to develop revenues rather than to raise money at start. And then when you raise money, you need always to be conscious that you will be raising money because you need to have alongside with you the right people to help you to grow the company. The people who can bring you money, but money is nice, but real support and real connection and access to distribution. So often it's better to be linked with people who have the capability to connect you with the right corporate, able to distribute you within their offers. And to do that, in fact, the VC model is not efficient because the VC model per construction, as it is today, it's limited by the construction of the VC, where you have a bunch of people raising money, then sharing management fees. So the model is not scalable.
So but the problem with all of this is, from what I'm understanding in this conversation, is that the values we're talking about are not VC values. We're talking under $1 million euros, under $1 million, under. I mean, those aren't VC values, are they?
What I brought, these examples?
Yeah, I
No,
mean,
you could do this at any size of the company.
Okay.
The point is, the most expensive capital available in the market is VC money because it's pure equity, and it's for both parties. It's the most expensive capital. It's for the VC, the most expensive, but also for the entrepreneur because you're giving up shares in return. And plus the strings come attached with it, such as liquidation preferences, which means the investor gets paid back first when there's an exit. And the moment you can reduce that equity dilution, you're off in a better position.
Okay, so what's interesting in your epiphany that you had in the last couple of years is that it's like that moment, is that it takes us a few steps back, maybe 20, 30 years back, to understanding startups as just another form of SME.
Yeah.
When you look at startups as SMEs, you start looking at different ways of financing them, and you start looking at, because the revenue-based financing is just a very glorified way of saying a SME loan.
Yes and no.
Yes and no.
Sorry, go ahead, please.
Well, if you look back at the venture industry, is that you need VCs because at the end of the day, banks are not willing to give money to entrepreneurs which have high risk model. And that's the issue, is that you need to be able to have some flexibility in your cash flow at the start.
But this is revenue-based. I mean, you're saying this is revenue-based. Every financial institution I've dealt with looks at revenue and says, okay, you're gonna.
No, they look at profitability.
No, profitability.
I look at revenue, but
Really?
there's a difference. But the point is, in B2B SaaS, that works for you because it could be anything. I mean, think of sales CRM, think of data extraction, workflow automation products, whatever. All these APIs that you can mash up, put a new layer on top, like a user interface. There's a lot of things you can do, and that you can grow not very quickly. You can launch to market very quickly with a reasonable amount of development hours put into 300, 600, 900 man hours of development, and that you can then launch in order to figure out whether there's some demand for this. And I mean, who here, like seriously, everyone has an audience question. Who here wants to run their own startup with $20,000 of recurring revenue, 2 or 3 guys, girls, and no outside investors profitably? No one? Come on, everyone, right? And the other option is, you take on a lot of money before, and then you need to somehow repay that money, right?
But if I may say, I mean, we have this discussion about VC because my belief coming in this industry is that this industry is the one urging people to take risk and to develop new innovative stuff, and which has so far been the less innovative in the way it works. So as for us, we have tried to think and develop a totally different model, really at the support of entrepreneurs. But if you look at Europe as a whole and the startup as an asset class, we need to have much more money coming to that industry everywhere in Europe. And we're lucky in France, I mean, because the French tech is super active, we have a lot of way to boost that. We have a very vibrant ecosystem. But I hope that all Europe, including Bulgaria and all the countries around, will be also space for entrepreneurial spirit. And for that, you need to have some new innovative way of bringing the local business angels supporting you. You need to educate people who have money to bring that money to this new asset class.
So how is what you're doing different from Angel.co?
Well, it's different.
And what happened to them? Because I don't read anything about Angel.go anymore.
Well, I can't tell what they are doing now, but the way we're working is that we're combining the strength of a crowd of qualified investors, people able to put few millions and also coming from the corporate, entrepreneurial, and institutional world, so good mix, international, combined with the power of an acceleration team, so important because we have the capability to scale the model, as we're not only dependent from the management fees to develop our model, because we have this advisory activity, which is nurturing, is a way for me of financing the development of the company and the tech platform. So, and I've been applying to our company what I tell to entrepreneurs: be innovative, find way of starting your company and have levers. Don't listen to the VC that tell you need to be focused. Sometimes you need to find way of developing side business to finance your core business, so has to be independent on the long way. And something also very important I'm learning, working in a lot of merger and acquisition deal and helping entrepreneurs to raise big ticket of money, is that you need to find and to work hard at the beginning of your startup on your equity story. If you want to develop a big company, at some point you will need financing, but you need to be in a good position to get access to the big ticket of money. And for that, you need, to think about your fundraise as a way of creating the brand image of your company and getting the right people to advise you in the path of development of your company. And often, entrepreneurs at the start, they want to have the money because they have no other option. And they're forgetting that the more you fund with external money at the beginning, the harder it is going to be then to scale the day you will need money.
So one last question, very, very quick, because we're out of time.
Mm-hmm.
How are VCs and investors, with both of your experiences coming from different backgrounds and covering quite a bit of the spectrum of VCs, how are they different from startups? Knowing that Cambridge Associates did a very extensive study of VCs, and they discovered that the majority, by far, don't return money to their LPs after management fees and performance fees are discounted. So how are VCs and investors any different from startups? There's a couple of hundred. If you are doing well, the rest are failing or barely returning their money.
Yep.
And if they are like startups, how do you advise the audience of entrepreneurs to pick the right investor/VC so that they make the right decision and don't end up putting their company in the hands of somebody who's failing with them?
So there's two aspects to that I'll address. One is, there's a one-sided fixation on unicorns, which I'm actually personally unhappy with, but it kind of comes from what I talked about earlier. So everyone just talks about the unicorns, the big stories, the big entrepreneurs raising $1 billion, etc., which is great for that particular entrepreneur, and as a role model, it may be great, and to listen to their speeches and conferences like this. But the reality is that a lot of people or a lot of entrepreneurs will start companies that will never get there. But if there was, in a healthy ecosystem, they may still be able to develop those companies to make a couple of 100,000, couple million in revenue even. And these companies still, would need our help. But the VC model, and which was greatly explained and or described, requires you to adapt yourself to that one-sided unicorn fixation. Otherwise, you will never get any money from them. And that is the main problem that I want to address. And so if you, I would be much more happy if 10 or 20 $1 million companies come out of this room in the next 12 months than if there was this, one attempt at a unicorn that's gonna probably never happen. Just, just the statistics. It's the fact that 80% of all M&A in enterprise software, and I've looked at the numbers over many years, are in the sub $50 million category, and 60 or 40, 50% is in the sub $10 million category. So that's the reality. And if you can build a company in this space, you can create personal wealth for yourself, and you don't have to share that with anyone.
And don't be obsessed by valuation. I totally share the view that you developed, Christian, is that many people are fixing about valuation, but valuation is a fake value. Because at the end of the day, you say, I have a unicorn, but unicorn means that one day your company could be valuated 1 billion. The day this company is exited, either bought by a private company or either listed. In Europe, when you exit your company at 100 million in your tech company, I can tell you it's complicated. We exited 2 companies last year at 110 and 250 million, one in France, one in Germany. Believe me, there's very few companies which are able to do that. So valuation is not the good insight. You need to focus on how you're generating in terms of profitability, in terms of revenue. There's no shame to build a kind of SMEs model rather than building a unicorn model. I mean, at the end of the day, if you want to be entrepreneurs, you need to do what why you're doing that, because you want to be free, because you want to develop your own business. So then be clear at the beginning of your objectives. And if you want to go for the unicorn, then you can go for this VC or for some very big financing.
It'll come later.
It will come later, you will see it. As for us, we prefer to invest deal by deal, because then it's much more complex. But if I give back to my investors 2-3 times per deal, I would be very happy. And maybe some of them will be 10. But the portfolio model where some VCs are saying, okay, I'm throwing money because I want to test, I don't think it's a good model. It's, I prefer to, we have preferred to change that model. And last but not least, when you select money, when you select an investors, it's a wedding, so it means that you're going to be married for a few years. So you have to be sure at the beginning that you want to work with this person, that you want to have this person on your board, that you want to be helped by this person, and make sure also that in case you're going to divorce with that person, you have anticipated everything so that it be smooth and don't challenge your business.
Well, the only thing I'd like to close with, I wish Dave McClure were here to answer that. I think there are different strategies. I love that there's your strategy. This is very rarely discussed. Most people don't look at this side of the coin. I do agree that most emerging markets and nascent ecosystems tend to have the 101 million as opposed to 100 million. You know who these guys are now, so come talk to them, okay? Otherwise, well, Stefan left, so, well, don't talk to him. But thank you very much, and I think that's a wrap, other than the startup competition, right? That's a wrap, and then stick around for the startup competition. It should be very exciting.